Have you ever noticed how the same company can be celebrated one decade and completely rejected the next? Why do investors, customers, and governments suddenly turn against businesses that once looked wildly profitable? Imagine two companies. One quietly dumps industrial waste into a river, hides the cost in its accounts, and reports record profits. The other spends more upfront to use clean energy, treats workers fairly, and reports everything transparently. 10 years ago, investors mostly chased the first one. Today, that same company faces boycotts, fines, and capital flight, while the second attracts loyal customers and long-term investors. Most people think sustainability accounting and ESG reporting are modern buzzwords created by regulators and activists, but the truth is they emerged to solve a very real and practical problem. Profits that look good today can destroy value tomorrow. To see this clearly, imagine something simple. When you choose to pay a bit more for a product because you trust how the company treats the environment or its workers, you're already applying the core logic of sustainability accounting, weighing long-term impact, not just short-term price. This is the Learning Studio, where we transform accounting and finance into real-world understanding. What's actually happening in that decision is straightforward. You're recognizing that business success isn't only financial. It's environmental, social, and ethical. Sustainability accounting captures this by measuring how business activities affect people, the planet, and long-term economic health, not just quarterly profit. The same idea operates at a much larger scale every day. Investors increasingly look beyond earnings to see how companies manage emissions, treat employees, govern themselves, and prepare for future risks. ESG reporting, environmental, social, and governance disclosure, turns these factors into structured, comparable information that markets can actually use. That's why companies like Unilever embed sustainability into their core strategy. Apple commits to renewable energy across operations, and Tesla reports environmental impact alongside financial results. On the investment side, firms like BlackRock openly demand ESG transparency before allocating capital. These aren't marketing choices. They directly influence funding, valuation, and survival. This shift didn't happen randomly, and it wasn't driven by one individual. It was shaped and formalized through global frameworks and institutions such as the Global Reporting Initiative and the International Sustainability Standards Board, which turned ethical expectations into standardized, measurable disclosures that companies around the world can follow. Now that you understand the intuition behind sustainability accounting and ESG reporting, the next natural step is to explore ethical technology and digital finance controls, how AI, blockchain, and data systems can be used responsibly in modern finance. Stay curious, stay responsible, and continue the journey with the Learning Studio. I'll see you in the next episode.